Eek. I'm probably not the first to tell you that the national debt is rough. 20 trillion. Oof. I ran some numbers, I did some research, and I found out that the average 70-year-old that owns a home in America is in $25,000 worth of debt. Non-mortgage debt. Add the mortgage in, we're adding another 75,000. But we're taking out the mortgage for today's example because why would you pay off a credit card debt with a reverse mortgage? Well, let's take a look because what I'm about to show you can change your financial outlook in a huge way while setting up a big safety net. Obviously, if you're in credit card debt, you've needed some funds. Let's see if the house might be able to help. Fun fact while I'm changing screens, the average homeowner at retirement age, when they get to retirement, has 83% of their net worth in home equity. How could you not use that? You're telling me you're trying to retire on 17% of your total net worth? Whew. Anyways, let's keep going. All right, I went to this credit card calculator. You can play with it online. It's a very helpful tool if you have credit card debt. And I plugged in 25,000. I looked up the average interest rate, 22%. And so I played with it and said, okay, what if we were paying $800 a month, which is the average you'd be paying on that? So I just took averages to come up with this. It will take 3 years and 11 months to pay off this balance, and you'll have paid $12,464 in interest to do so. And these are required monthly payments. In retirement years, you have lots of different life events that make required monthly payments kind of rough. Now, if this is you, I'm speaking to you because it's hard to get a reverse mortgage if you're behind on things. If you already start making late payments, and in this kind of treadmill, we start to see that. So before you start making late payments, put a reverse mortgage in place and pay off the debt that way. Or at least hear me out so you know your option. All right, let's take a look. So I'm going to model on my other screen. This is an example of how old is this person? Oh, sorry, let's go back. Okay, I don't know. This person's probably 73. That's my typical average. Home value of 300,000, no mortgage. And the interest rate on a reverse mortgage in order to pay off this 25,000 of credit card debt would be 7.27. So what we're talking about is putting a reverse mortgage in place for more than just paying off the credit card debt. There's a bunch of reasons to do this. We'll go over them in a minute. But the main reason right now that we're modeling is to pay off 25,000 of credit card debt. Now, Christina, why would we do that? Why would we just transfer the mortgage to the house? Well, because 22% credit card interest with required monthly payments is a far cry from 7.27% interest rate, non-required monthly payments, and we're going to set up a huge line of credit in case something happens in the future. All right, so let's lower this 22% interest rate. What happens if I put in 7.27, the interest rate on the reverse mortgage? Well, we went from 3 years and 11 months with 12,000 in interest paid. We're going to keep the same payments. You can make payments on a reverse mortgage, and in this strategy, I'm saying you should. 2 years and 11 months, so you're paying it off faster, and the interest you paid is $2,799, $10,000 difference, and these are non-required payments. So the interest will change if we don't follow the plan, but at least you're in control. At least you have the ability to not follow your own plan. It's not dictated by the bank. With a reverse mortgage, you can pay in any amount at any time or don't. If you make a payment, they cash it. It goes to lower your interest and the balance, and it goes dollar for dollar to increase this line of credit, which is the real power here. So let's take a look. All right, so we've modeled taking 25,000 cash at closing. That actually leaves us with a line of credit available to you. Now, you're not getting charged on interest on a line of credit. This is just saying of the equity in your home, you can borrow 86,000 of it. Now, the reverse mortgage line of credit cannot be frozen simply because the real estate market crashes like other lines of credit can. It's open the entire time of you have this mortgage. So unlike regular, like a HELOC or other lines of credit, they're typically only open for 10 years for you to use them. And then the remaining 20 years, your payment goes up to pay the whole thing back. Not a good fit for retirement. I have a lot of feelings about that. Let's go into this example though. I'm going to increase the size so you guys can see. Now what we're looking at here is the years out from today, the average interest rate they expect. This is an adjustable rate mortgage. Don't be afraid of it. There's no payment attached that's required, so the adjusting rate actually benefits you if rates go down. And there's a cap on it if rates go up. We are going with disbursement of $25,000. The way that would work is at closing, you would get $25,000. You would take that money and you would pay off your credit cards. LOC means line of credit. The remaining amount the lender's willing to lend to you is left on a line of credit, and you can borrow it and pay it back and borrow again, and it actually grows. Why? Because your house is appreciating and you're getting older. And so when those two things happen, they know people likely want to get access to more of their equity, so they built in a growth feature. Now, all this is increasing your limit. Just like on your credit card, your limit might be $10,000. You can increase that to $15,000. That's what's going on here, but it's happening naturally. So in this example, if you wanted to, some of my clients do this, and it's a great strategy because, let me move my face. You can see the equity column. Let's move over here. Okay, the equity in your home continues to increase even if you just move this $25,000 over and you don't make payments on it. So if those credit card payments, your cash flow is a problem, this is a really smart strategy because your home appreciates. Now, assuming you're in a market that appreciates, every now and then there is a market that doesn't appreciate and the numbers won't work, but generally most markets are appreciating. And the numbers still work to get you out of the debt. It's just the long-term equity. I try to meet three things. What do you need now? What do you need through retirement? What do you need at the end? Some people will have to sell their home in order to move to a higher level of care. It's just a given. A certain percentage of people will have to do that, even if that's not in the plans. So I protect my clients. I think it's important that we protect the equity so that if you are in that situation, you can sell the home, get the remaining equity out to pay for wherever you're going for that care. So the equity column is here at the end. You can see, even if we just paid off the credit card debt and never made a payment to this thing, your equity continues to increase. That's what people are concerned about. Now, really cool, your line of credit grows too. So if you do this and don't pay off the credit card, which I'm going to go into paying it off in a minute, if you don't pay it off, in 10 years, your line of credit went from $86,000 to $174,000. You can borrow that if and when you need it without any questions asked. You don't have to qualify at that point in time. Doesn't matter what your credit is, doesn't matter what your income is. Set this thing up while you have good credit and good income and you know you can. All right, then the mortgage balance does increase. You're not making payments. So how does this work? The payments are added to the loan balance slowly over time. The interest and the mortgage insurance is added. Let's show paying off this credit card. So let me move my face again. Moving down here. All right, the credit card calculator. So what do we want to show? We want to show paying payments for about 3 years. And we're going to pay $800 a month. So what is that? That is, let's go 800 a month times 12. So an annual payment, which is what I need to use for the software. If you pay $800 a month, not required, right? If you need to stop, you can. But let's just show if you actually follow the plan, you would pay $9,600 a year for 3 years. Oh, weird. Okay, and put it in here. Okay. Now, the cool thing, did you watch how the numbers changed? If you didn't, go back. It's cool. As I typed those numbers in, the numbers changed on the line of credit, the numbers changed on the balance, the numbers changed on the equity. So now we're modeling pay off that debt that you just put on the reverse mortgage. And look at the loan balance goes down because you're paying off that debt. And then it goes down and it hits a low number here. And then it starts to grow, right? We're saying only make payments for 3 years. And because you've done that, your actual interest incurred went down by 10,000 bucks. But at the same time, there's huge benefits what you did for yourself in retirement. First of all, you took all your worries away because you have all your financial worries. If you're already in credit card debt, there's a high likelihood that you may need to borrow more money. So why don't we do it smarter? Your line of credit, by making those payments, went up dollar for dollar for every payment you made, and that increases your capacity for that line of credit. So now, let's look 10 years out. Now, by doing that, your line of credit has gone up to $224,000. If you need care brought into your home, if you need to remodel your house, if you need a new roof, if you need a new car, if you just want to go to Tahiti, you have $224,000 to handle all of those things. These proceeds, this is equity in your home. It is not taxed as income, and it is your equity. You can use it how you see fit. Really, really nice way to use this. There's a lot of different strategies I could be going over here. I just want to help those who are in debt on this particular example. I have other videos on here. Please go watch them. Other strategies, other examples that might fit your situation better. But this is the debt one. So I just isolated it down to the debt. Now look at the loan balance. It's nothing crazy. Look at it. It doesn't even get crazy. At 26 years, the loan balance is only $70,000. And at the same time, your equity, yep, it increased right off the page. And this is only at 4% appreciation. I'm in Oceanside, California. Our long-term average appreciation is close to 7%. So these numbers are not accurate for my market. They're really, really low. Most people who sell with a reverse mortgage get a lot more equity than they were expecting based on these projections. If you're in a market where 4% is more accurate, then these numbers are accurate for you. If you're in a market where 4% is high, then keep that in mind, knowing that these numbers may not be accurate. You can look up your appreciation online. Just look in your zip code, average appreciation, and look for a longer period of time. Don't do like 1 or 5 years, do like 10, 20 years to know if that's accurate for you. Also, if you ever wanted me to model this stuff for you in your specific situation, like for example, if this was a San Diegan client, I could do this and put the actual appreciation at 7% where we know it actually is, and then look at the equity. And these are real numbers. Like houses in San Diego are quite expensive. And so a normal house could get to this. The equity continues to increase, even with only making those payments to pay off the debt. But let me show you, let's take it back and go to 0 again. They're still really, really good. If you are in a market like in California, in Texas, in Florida, pockets of Washington, pockets of Colorado, pockets, Texas, I said, anywhere where there's high appreciation, you might want somebody to model these numbers for you. I can also do 0, right? If you're somewhere where there is no appreciation at all. But check this out. For a normal San Diegan house, even with never making a single payment to this thing, the equity continues to increase, and it increases a lot. So the idea that a reverse mortgage takes away your equity is not true. What is really powerful here is that the line of credit grows big. Look at that. I mean, not that many people are actually going to live that long to see that, but if somebody does, you got $500,000 in 26 years from an initial line of credit of $86,000. I wish everybody understood the power of these things. Reverse mortgages have changed a lot in the last 10 years. If you haven't got an update, call me. I'm happy to give you an update. If you're a loan officer and you want coaching on how to understand and run this stuff, I can do that too. Look at the show notes. Look at the link in my bio. I'm happy to help you whether you're a consumer or a loan officer looking for coaching. I will say I'm not licensed in all states. If I'm not licensed in your state, I will be able to get you to somebody that is good and hopefully has my same designation, CRMP. There's only about 200 of us in the country. And do me a favor, if this was valuable to you, like this, comment, subscribe to my channel. It helps everything so I can get free content, give away free information that's real and valuable like this. Thanks so much and good luck with all of your finances for retirement.